Hello and welcome to the extensive weekend video, which is called S&P 500 Short Squeezing on Stagflation. Right, let's examine whether this move can last, how solid it is. We will dive into sectors, plenty of price action on intraday charts, and of course volatility readings. This is the situation Friday pre-market when I had called for upswing following the opening bell based on options market clues, because we had seen a spike in put to call ratio and day's trade would be unwound. We would dive into that later on. So what had followed since? Upswing, University of Michigan data release, stagflationary scare, markets tanking. However, sellers were overpowered and could not force downtrend resumption at that moment. We will examine why. Apart from 5,555, the next level, 5,615, was the one characterizing range of latest days when we saw Thursday's price action breaking down below this and then returning, and this short squeeze developing after University of Michigan data. Volatility metrics have indeed looked kind of mixed. However, I will be examining further on in this video what these are actually telling us and how to read them. Thanks for liking this video and subscribing to the channel. Your likes help greatly, especially if you appreciate this content much and helps you get better in your own trading. These are the levels. 5,555 mentioned below. It had held pre-market, was tested, modest upswing developing, the long green candle following the open, that's based on the options market positioning at Thursday's close. Rejection once University of Michigan data had been released, refusal to sell down further into the range, and squeeze starting to develop. And it had overcome 5,615, twice backtested that level, and in the end attempted a breakout of 5,630 to 35 area, which are the two uppermost turquoise lines. What did it do with rate cutting expectations? Stagflationary data. Did it readjust rate cutting odds too much in favor of Fed keeping the rates as high as they are? Slightly it did. We will as well see plotted the yields chart, and I will talk the US dollar as well. However, that reassessment of rate cutting odds had not been too pronounced. This is your hallmark of risk on day coupled with a short squeeze, all happening on extremely light volume, which detracts from the credibility of that move. It doesn't mean that it can't continue, but I will present my opinion with reasoning as to what I'm looking for equities doing right away Monday, practically Sunday after Globex open. So we would see discretionaries outperforming staples, risk on sign, okay, tech, financials, discretionaries and communications doing okay, industrials following nicely. However, this would be too easy if it were like that. I will revisit this sectoral overview later on when we dive into the long-term charts. This is the weekly one. For all the retracement and squeeze Friday, we ended up with yet another down week. Would I say that the buyers are overextended here? Not necessarily. It will take a little moment to decisively roll over to the downside, and the buyers would have to get Bank of Japan especially out of the way first. The daily chart. We had seen the bear flag, the prior two candles with notable lower knots, followed by a breakdown, and now retracing higher. If this does not scream a trap to you, then nothing will, because this is a very trappy setup, and I do consider the return of the sellers as being only a question of time. So let's dive further on into its timing. Here you can clearly see the very low daily volume, which is not at all convincing, not at all. Let's examine the percentage of stocks trading above the 20-day, 50-day and 200-day moving averages in this sequence from the top to the bottom, right below the price chart. The 21 just indicates that stocks had been short-term very oversold, but they had been oversold for a while, so they could have just as easily taken the stagflationary data excuse and not squeeze, but to remain more within the body of the preceding long red candle. This did not happen. However, I was telling you that a short squeeze developing is a question of time. What is the trouble is that it never kind of lasts more than a day, maybe 2 days, when there is some portion of pre-market price action that borders on the indecisive. So much for the very short-term percentage. This was at the oversold level. The next one, the 51, that's also kind of in distribution, but those readings are clearly above 30, it's actually 34.20, which is very far from a bottom such as what we saw in December. Right after the botched FOMC delivery of Powell not being able to explain why he did cut rates exactly. So we see that the percentage of stocks trading above their 50-day moving averages is not looking at all bottomy, has some way to go still, and anyway it had not flipped the 50 line. Actually it is below, so it shows that the sellers are in control. 50 is an important demarcation line in this one. The 200-day moving average, that one is looking even worse. So it is as well, it is looking clearly worse on this chart. However, if you look at the y-axis, the level of 40 is not really disastrous, but what matters is the 50 demarcation line, and that one is what institutions, hedge funds are looking at, and they would assess this market as one being in a downtrend. Therefore, so much for all the 10% correction headlines that are floated frequently in media. It's in my view very incorrect to assess this move as a correction, because frankly you don't know where it's going to end, and the odds are of this actually continuing. The only question I have is whether stocks and how much they do roll over to the downside already on Monday, meaning how much of Friday's upswing, Friday's short squeeze will be retraced. And I will bring you a few clues as to what to expect from Monday further on when we look at volatility and options market positioning. So, this examination of percentages of stocks trading above various moving averages clearly disproves us jumping to the conclusion that this is just a correction within a bull market. We don't know whether it is still a bull market. This can very easily continue turning into a prolonged period of distribution, price distribution, stock distribution. Are insiders buying or selling? That's your another clue. So as to answer the question of longevity of this stock market downturn that has the potential to turn into a longer lasting downtrend is McClellan Summation Index. I had been already bringing it up throughout the week, and you can see clearly that even before elections, it had been quite apparent that stocks are under distribution because each successive high had been formed lower. Note as well the pre-inauguration corrective bottom and the move to the downside in the weeks preceding inauguration that I had called, how well they are confirmed by this long-term, slow-to-turn and really rolling over slowly, as you can see, indicator. Since then, we had seen the post-inauguration rally and making another lower high, and compare that where stocks had been by then. They had mastered a breakout to new all-time highs and were rejected in there. But this latest bump that you see on the right side of this chart just shows how internally weak the stock market actually had been. Looking at the sectors, this was the chart that I had shown you already. This would just serve to lure in buyers, chasers, and force short covering, because it is quite uniform across the sectors, yet still gives some risk on vibes. So let's do just as with the summation index and larger breadth readings when we were looking at various periods of moving averages, how many what's the percentage of stocks trading above them. Let's take a longer term view here as well and examine the 5-day, meaning how well have individual stock sectors performed over the last 5 trading days, meaning this week. We see that still S&P 500 had another fourth at least down week. Utilities had been the only one outperforming. Tech had not been in the driver's seat at all for all the Friday's hoopla and relative resilience of Nvidia that I had commented on Twitter already. This is not enough to shield the market from further declines. And you can see that consumer discretionaries and staples have declined by almost the same percentage point, because percentage value. because consumer sentiment had been coming in quite on a worrying scale. Record lows. These were the University of Michigan data had been worst in the last, say, 2 to 3 years. There was just one similarly bad reading, and if you just examine this price chart of S&P 500, pure price chart, and the false breakout to new highs, what had forced such a steep selling? It started one beautiful Friday with the jobs market data and the fear about stagflation. Be it stagflation, be it fear of recession, consider that at the start of the year there was a 10% odds of a recession occurring this year. This is pretty standard figure. It's always around 15% every single year, the odds of a recession developing during that particular year. However, right now the odds are at 30%, and you know that I had not been calling for a recession. I had been calling for a soft patch. I had not been even calling for a growth scare. I had been calling for continued stagflationary fears. But that mixes up well with what I had been saying and how I had been walking you through before CPI, when I had called for low CPI to come, when I had been adamant that inflation actually, as per the metrics that the Fed and macroeconomists are looking at, is not accelerating. And Thursday's PPI that came on a deflationary end of the spectrum did not force such a fear as July CPI coming negative last year did. So I just wish to highlight here that it's up to the consumer what's the shape, what's consumer perceptions about the future. Record high inflation expectations, record low consumer sentiment. We have tariffs, very fluid situation with measures, countermeasures, policies, and it's practically developing hour by hour, and this has impact on corporate earnings, forward guidance, already sky-high multiples, high beta stocks being hurt the most during this downswing. High beta stocks, but what had been the index tanking the most? It had been Russell 2000. And it's pretty obvious if you open, for example, for our chart to see all those little gyrations to the upside, how impotent they are when it comes to the small caps. And you remember those highly publicized calls of very bullish stocks and Russell 2000 leading in the second half of 2024. No, summation index and long-term market breadth indicators are clearly saying that this is not the case of what to expect in market breadth positioning to happen. So much for the 5-day sectoral performance. I will be linking to prior videos where I summed up on 2 lines essentially the reasons for the stock market sell-off, which I say might very well turn into a pretty neat, clear, regular bear market, meaning according to the mainstream definition of overcoming a certain percentage peak to trough, and then it's on. So once again bringing up what made me to go for S&P 500 upswing right after Friday's opening bell, and it was this sky high rush to puts at Thursday's close, and these getting unwound, and now after the weekend the market players are ready to put them on again, so we can expect another bump which will coincide with forcing equity prices lower. So I expect already an S&P 500 bearish gap Monday. My favorite metric of volatility: wicks to forward-looking wicks to short-term wicks. You can see that this is showing no signs of relenting. This is a clear line higher, and there had not been any kind of climactic release. All the long white candles, they had been starting from already extreme levels of complacency, and this one is the direct opposite. It's rejected maximum fear at Friday's open is being rejected, and that coincides with the long black body starting at very high levels. Don't be misled by this plain VIX chart, which would hint at, oops, we don't need protection, we don't need puts anymore. No, that time will come, and that time is actually reasonably short. So, considering the latest ranges where VIX had been moving to talk about its bottom at almost 22, that this is the area where a new downtrend is ready to start, when we have had nothing even remotely commensurate with the longest white candle, which again represents December FOMC meeting. There had been nothing like that. The temperature is being turned up still, and the casserole had not boiled over. So we are still in for the moment of maximum pain and deepest decline to levels that we could right now imagine as unimaginable, or basically not imagine them to be possible to be reached. One more chart of yields, and this is probably one of the parting ones, and it will be followed by the S&P 500 levels that I expect will be ruling throughout Monday and basically the opening part of the week. Just as with S&P 500, I have been telling you that there is a bear flag. Now we see exactly the same structure being formed in yields. Yields are ready to retreat some more, and it is a question of time, because it's in the stated interests of Trump administration to get lower yields. Note as well, compare that with how the dollar did. The dollar did not remotely enough spring to life, and is still very far away from the at least 104.50 level, which would be still a very tame level of retracement, which tells you exactly which way the dollar is headed over the weeks ahead. And it's always a question of only a path, so play the game of timing and pinpointing where the retracement is going to stop at your own peril. It's really much better to adjust the stop losses and what we are aiming for in these trades, rather than try to get every counter trend move in this record uncertainty and extreme headline sensitivity. This is the promised chart once again, and you can clearly see the difficulties that S&P 500 actually had keeping above the range of 5,615 to 5,635. These are the uppermost and the third one from the top horizontal lines drawn. And once again, the rejection at the close is pretty telling as to which way the positioning is going and who would be having the stronger hand when we open Monday and when retail just looks around and sees, oops, that was another trap. So it's a question of how big a trap that will be built actually. Thanks again for liking this video and subscribing to the channel. My joint page will help you select what's right for you based on what and how you trade. I can't stress enough the importance of having access to my real-time thoughts, daily analytics, and the Telegram premium channels. You know pretty well my trading journey and everything that's going on Twitter. Disclaimer, and have a great weekend.